Alright, hi everybody. I recently came across a tweet by a market commentator that reached almost 300,000 people. And in this tweet, this gentleman highlighted that we are likely on the cusp of arguably, quote unquote, the largest recession and bear market since 1929. So are we really on the brink of another 1929 market crash? We'll discuss this in this video. So without further ado, let's get started. Alright, hi everybody, welcome back to another video. So as I said in the introduction of the video, I want to discuss the prediction that we are going to experience a 1929 market crash, which for context was one of the most severe market crashes the US stock market has ever seen. So this was a tweet by Henrik Seberg, and I'm just going to display the tweet to you on screen right now. So he wrote, "Tell me again how we are not in a bubble." Exclamation mark. This is the S&P 500 adjusted for inflation. So he's referring to the chart that he added to this tweet. I'm sure all is fine. Largest recession and bear market since 1929 coming. But first, a blow off top. So now I'm also going to show you the chart on screen in large right now. So what we are basically seeing here is, as he described, a chart of the S&P 500 over time, over the last 100 years, more than the last 100 years, in fact. So we're going back all the way to 1871. And then on top of that, he added a chart in which he highlighted the current PE ratio of the S&P, so the current price to earnings ratio, as well as the current reading of the S&P when it comes to the Buffett indicator, so the market cap to GDP ratio. And I'll discuss all of that in a moment. So the point I'm trying to make here is, I think as an investor, it's very important to be a second level thinker. Meaning, well, if you read this tweet and you are a first level thinker, well, all of that makes a lot of sense, right? You see this chart that shows, I don't know, it shows a chart that looks like we are in a bubble. It's almost a vertical rise of the S&P in the more recent years. We have metrics like the price to earnings ratio and the Buffett indicator that are at similar levels to those of past market peaks. In fact, the Buffett indicator is almost twice as high as it was, for example, in 2007, right before the great financial crisis. And all of this, if you're not critically questioning it, points to a potential stock market crash. However, as you can maybe already sense from my intonation, I don't fully agree with this take. I would argue that as an investor, you have to possess the ability to critically assess information, to question them. Is the surface level interpretation the only potential interpretation, or are there other relevant factors you need to take into consideration as well? So I want to highlight 3 weaknesses of the comments made by Henrik here. First of all, it's important to understand what kind of chart we're looking at here. So we are looking at a linear chart of the S&P, a price chart, an inflation adjusted chart over more than 100 years. And the longer the time frame that you're looking at, the more inappropriate it becomes to assess whether we are in a market bubble or not, or to assess whether there's a meteoric rise in more recent years when it comes to linear charts, or charts tracked on a linear scale. So just for context, so back in 1920, I think the S&P was standing at around 20 points. Now we're in the thousands. We hit the 6,000 point mark not too long ago. And obviously, any moves from the past, even if the market crashed by 50%, will look ridiculously small. You won't even see it on the chart. And any movements in the more recent past, even if it's just a 10% correction, will seem more dramatic. But this will inevitably lead to the quote-unquote perception of us being in a bubble right now, just because we see this meteoric rise of the recent bull market over the last couple of years. So I would argue, if you consider the very long-term performance of the S&P, it's better to consider the logarithmic scale, or make use of logarithmic scale charts, because they better reflect more recent movements and how extreme they really are. So on screen, I'm just going to display to you a comparison of both an S&P inflation adjusted price chart on a logarithmic scale, and on the other side on a linear scale. And just to sum up this first point, so when you see a chart that looks like there are extreme movements, always make sure what kind of scale you are looking at right here. Moving on to the second part. So if we go back to the Buffett indicator figures shared by Henrik here. So he highlighted that in 2024, the market cap to GDP ratio, and I'm going to show you a chart displaying the development of the Buffett indicator in the US, specifically over time. But he highlighted we're standing at a metric of 208%. And just for context, 2007, at the peak, we had a reading of 105%. In 2000, so at the peak of the dot-com bubble, we had a reading of 137%. And in 1929, the market cap to GDP ratio stood at quote unquote just 87%. So just looking at this number and the current standing of the Buffett indicator, it seems like we are in a massive stock market bubble, which I think is not accurate. And there are various reasons for this. One clearly would be that you have to understand that this metric takes into account the market cap of all US companies. Or I would actually have to double check. I think it's looking at the S&P here. All S&P 500 companies relative to the US GDP. However, the underlying components, the underlying nature of US businesses has obviously changed over time. US businesses are nowadays much more global than they were back in 2000 and obviously back in 1929. So this fundamentally changes the equation and the result of this particular metric. Consider businesses like Microsoft, Apple, McDonald's. They all earn a good amount of their overall revenue internationally. In some cases, more than half of revenue comes from overseas. So clearly comparing, in a way, global market value. So the earnings power of businesses internationally is reflected in their current market caps. Comparing it to just domestic GDP, well, I'm not going to say it doesn't make any sense, but clearly you're comparing apples to oranges if you're comparing the Buffett indicators reading back in 1929 to today. Moving on to another facet here. So the rise of intangibles. Nowadays, many businesses are very tech heavy. They are investing in research and development. They are investing in brands. They are investing in network effects. Many are investing heavily in marketing to build the brand that I was just talking about. All of these intangible assets, that's not really captured by GDP. It just gives the businesses more pricing power, better earnings, better profitability, leading to higher market caps, which in a way will again skew the Buffett indicator upward. Put differently, a higher Buffett indicator may just reflect a structural shift of the nature of many US businesses. Okay, moving on to the last part, the price to earnings ratio. I can cover this fairly quickly. So that is something I talked about in previous videos as well. Sure, we are looking at quote unquote elevated price to earnings ratios in the US specifically for various indices, not only the S&P, but also the Dow Jones, and also the Nasdaq Composite or the Nasdaq 100, for example. However, I think what you also have to realize is that, again, the underlying nature of the components of the businesses has changed. Arguably, we're looking at much higher quality businesses today compared to, say, 4 decades ago. Many of the most important and highest weighted members of the S&P today, the Amazons, the Googles, the Metas, the Microsofts, those are some of the best business models the world has ever seen. They are global businesses, so they have high global diversification. They have high internal diversification when it comes to different business segments. Take Amazon, for example. Amazon is not only their first-party e-commerce business, so there's third-party, there is advertising, there is cloud, of course. You have the subscription business within Amazon. And many of these business lines, if we talk about Amazon specifically, are producing highly recurring revenues, which is again another quality feature. If you look at the margins of Meta, for example, the core business in the most recent quarter, I think it produced operating profit margins of 60%. Those are almost unheard of profitability levels, which manufacturing heavy businesses in the past weren't able to produce. These businesses were much more capital intensive, much more cyclical, much less diversified when it comes to the different revenue sources. So clearly you could argue that the higher quality of US businesses today might justify a higher price to earnings ratio, which would not necessarily mean that we are looking at an overvalued market. So to get back to Henrik's tweet here, does the metrics he referenced here indicate that we are at the brink of a 1929 crash? Well, maybe, but maybe not. I think it's always important to critically assess the information presented to you. And as I just highlighted to you, I don't think the signals are as strong as Henrik suggests in his tweet. I think as an investor, it's always important to remain calm, to assess information rationally, and to then evaluate the businesses you own, so the stocks you own, independently and individually. Okay, that's it for today. Let me know what you think of it, whether you think we are on the brink of another 1929 crash or not. And I'll talk to you in one of my next videos. Take care.